Welcome to this Killick Explains video. What I want to do is pick up a specific change from the autumn budget, that's 2024's autumn budget, for those people watching this in a few months' time, which deals with the issue of unquoted shares specifically. So as a rule of thumb, the government likes to give investors tax breaks of some sort for investing in smaller, faster growing companies. This is one of them, but the rules changed as a result of the autumn budget. There's still a good tax break here, but it has changed. So come back to what unquoted shares might be in a moment, but essentially in the old days, pre-autumn budget, if you like, the inheritance tax relief was 100%. What does that mean? It means that if you were holding these qualifying shares, and we'll come back to what they are in a moment, basically they could fall into what's called a death estate when someone died who held those shares, but the relief was 100% of their value. So under something called business relief, or in old money, business property relief, you could basically say, well, they should be in the death estate, but there's 100% relief applied to them. And that means that they wouldn't be subject to inheritance tax of 40% in the normal way, like all the other assets in a death estate. The change is that from the 6th of April 2026, but before you think that sounds like a long way away, hold on for a moment, that 100% relief becomes 50%. So only half the value of these qualifying unquoted shares can now be basically taken outside of a death estate. The rest is tax. If you want to say it another way, that increases the effective rate of inheritance tax from what used to be 0 when the relief was 100% up to 20%, because the full rate of inheritance tax is 40. So if you're getting half of the value of these shares taken out of the estate, that reduces it to 20. All right. Now, that's not great in the sense that, obviously not paying any inheritance tax and having to pay a 20% rate isn't fantastic news, but it's still better by some distance than a 40% rate. Same conditions apply, and this relief is available whether you hold the shares inside or outside of an individual savings account. If you hold them inside an individual savings account, you also get the income tax and capital gains tax benefits that come with ISAs in general. So what's the deal here? You need to buy some shares that meet the conditions. It's not all shares by any stretch. Come back to that in a moment. You need to keep them. There are quite a few conditions attached, but here's the main one. Keep them for a minimum of 2 years. And then there is potentially this thing called business relief, or business property relief, to use the old language, on death, or if the holder, having kept them for 2 years, passes them on while they're still alive. So 2 situations in which this, what used to be 100% relief, but will be 50%, now kicks in. And bear in mind, here's the catch. If you're thinking, well, April 2026 is a way off, isn't it, Tim? But think about it, the minimum holding period is 2 years. All right, so if you roll on 2 years from the point where you're watching this video, you will get past that April 26 date. That's why it's relevant now. So what are you buying to try and get this, what will be now 50% reduction in a death estate on the value of shares that would otherwise be taxed at 40%? Okay, well, the answer is unquoted shares. And probably the best known example of those are shares on what's called the Alternative Investment Market, or AIM. So let's say a word about those. This is a separate market to the main list at the London Stock Exchange. It features lower regulatory hurdles, so it's easier to get onto, and that tends to mean it attracts young, fast-growing, exciting companies. Not without risk, come back to those in a moment. So why do firms want to be on this AIM market, if you like, as part of the London Stock Exchange, but not on the full list? And the answer is, well, fourfold, really. It's a way to access capital, it's a way to raise money. It gives them credibility. The very fact they can say they're on AIM helps. It gives them more publicity. The media tends to pick up on companies that have moved onto AIM, and it can be a route, not for everybody by any stretch, through to a full listing one day. It's kind of the holding chamber, if you like, between being completely unknown and possibly being fully listed, if you meet all of the more stringent criteria for a full listing. As for investors, who wants to buy these stocks then? Well, you are arguably buying, as it's been put to me, tomorrow's names today. these are stocks covered by fewer analysts. So if you find a good analyst or you're prepared to roll your sleeves up, there's potential to buy stocks which are a little bit ignored by the main market, and that can be an opportunity. And of course, there is the potential for this specific tax break, which doesn't attach to fully listed shares. It's only available for what are called unquoted shares, of which AIM stocks are a good example, probably the best known. Now, there are no free lunches. You're aiming to get what will become a 50% reduction in the inheritance tax rate. Used to be a 100% reduction, if you like. There's going to be a price for that. So these are shares which are generally more volatile than bigger shares, for example. They can be prone to failure. Right? Some of these companies don't make it. Liquidity, and that means bid to offer spreads, can be a problem. Generally, the gap between what you will pay to buy and sell these shares is wider than it would be for other stocks. There's a possibility that a stock won't qualify for business relief because you only find out once it's qualified, if you like. You only get it confirmed, usually, that the stock has qualified, and you have to be careful. Don't look at this as a tail wagging dog situation. In other words, don't go for the tax break, forgetting that there is a price for it potentially in the form of higher than average risk companies. All right. One final note before I wrap up, and that is that AIM shares do count fully in the calculation of the residence nil rate ban for inheritance tax purposes. And that's worth keeping in mind if you're likely to leave an estate worth 2 million or more. Not a condition that applies to everybody, but if it does, be careful with the way you interpret the reduction in inheritance tax. Okay, quick summary there. Lots more you could know, both about inheritance tax and AIM shares actually. So Killik.com/resources is where you'll find other videos, my how-to guides, one of them is called How to Invest in Equities, and also a copy of our latest quarterly magazine, Confidant.